Welcome to this, the latest edition of the Weekly Movie Report. Let's start with US equities. I'm sending this update out a little early this week because Tuesday's price action in the markets could be the start of something bigger. Now, I'm not changing my primary bullish stance on equities, but more evidence of a potential counter-cyclical correction is coming to the fore. We need to see some benchmarks broken before I can be more certain of this. So let's take a look at the evidence. Here we see my Dow diffusion indicator. It's now very overbought, and that's important because these arrows show that reversals have often triggered timely buy and sell signals. The fact that the indicator has gone sideways from a very high level is now a cause for concern, especially if we get some trend breaks on the downside. This is the one for the Dow, and that line is around 9,000. This chart shows the S&P, and the indicator in the lower panel is my aggregate KST. It's constructed from several US indexes as well as European and Japanese ones. It too has been reasonably reliable, and it's currently bearish and moderately overbought. That suggests that this line for the S&P might be violated too. I'd say a daily close much below 980 would trigger the signal. The red 200-day moving average is about 100 points lower. I doubt that even if these bear signals are given, the market will move any lower than that. The top series in this chart is the MSC World ETF, the ACWI. It's literally right at its trend line. The Nasdaq Composite has experienced a very moderate break, but the high-flying emerging markets index has broken its line. Note how this strong sector failed to confirm the recent S&P high. That's not good when the leader fails to lead, and it's often the sign of an intermediate peak. This chart shows two confidence ratios that move up and down with the S&P. First, the ratio between stocks and bonds. It's right at its uptrend line. So too is the relationship between financial stocks, the IYF, and government bond prices, the TLT. Since the two KSTs in the bottom panel are weakening and are moderately overbought, I doubt that a violation of these two lines can be avoided. Here's the VIX, or Volatility Index. I plotted it inversely to correspond with price movements in the S&P. These waves show there is a good correlation between the two series. Now I'll overlay them on the S&P. Note that the inverted VIX has already started to decline. In other words, indicate greater volatility, and that's before the S&P started its decline. That is a bearish sign. So is this trendline break, and the fact the KST for the VIX is also declining slightly. Finally, another quality spread, that between high-yield corporate bonds and governments, as expressed by the two ETFs, the HYG divided by the TLT. Note how the ratio often leads the S&P. Here is a negative divergence, here's a positive one, and more recently a negative one again. Finally, the ratio has violated this uptrend line, suggesting people are starting to lose confidence again. Okay, we have some very negative looking setups, but I'm going to wait for the S&P to crack its uptrend line at 880 before getting too excited. Even then, I still think any decline that is signaled would be counter-cyclical in nature. Next, the US credit markets. Both momentum indicators are positive, so that should allow the iShare Lehman 20-year trust to break above this resistance trend line at $97. Now for the dollar. The KSTs shown in this chart are mostly positive for the dollar index. However, Tuesday saw the price rally and close above this very important downtrend line. It's significant because it's quite long and has been touched or approached on numerous occasions. So the breakout ought to provide some unexpected fireworks for the dollar bears. Precious metals. The gold price has gone unusually quiet as it reaches the moment of truth between these two lines. The gold AD line, which measures the cumulative plurality of gold expressed in many currencies, is also caught between two trend lines. It is also telling us that a good move probably lies ahead. Now, some encouragement for the bulls came on Tuesday because the KST ticked up ever so slightly, but not enough to trigger a signal. I'd watch the previous high at 966 and the previous low at 934 for a signal that tells us the direction of the next major move. Commodity markets. Our ratio between inflation and deflation sensitive stocks has completed a head and shoulders top. So too has its special K, an indicator that monitors primary trends. Here you can see how it signaled the recent bear market. The completion of these two formations not only suggests that defensive early leading stocks such as utilities and financials will outperform energy and other late cycle leaders, but that commodity prices themselves will come down a bit. The connection between the CRB composite in the second panel and the ratio is self-evident. On Tuesday, the CRB closed right at its uptrend line. I think it's going to go through. Now we're looking at the Dow Jones UBS Commodity ETF, the DJP. Its comparative trend line is at $36, and the declining momentum indicators suggest that it will break the line. Finally, some good news, at least for us drivers, as the gasoline prices violated this important uptrend line. Since this has been confirmed by the two momentum indicators, I think we're going to see lower prices at the pump for a while. In summary, 1. Equities are now more vulnerable to a correction. 2. The dollar breaks to the upside. And 3. Gold is still within a narrow trading range. Look for a break above 966 or one below 934 to signal the direction of the next important move. Well, that's all for this issue. We'll see you next time, and in the meantime, good luck and good charting.